Thank you this morning for your love and your care and your blessings and protection upon each one of us. Even as we gather here, we pray that you may help and guide the people who make presentations so that we can work together with the media to see how we can build and confidence in our capital markets. We thank you for everything, and we pray that you give us a successful day. For I pray all this believing and trusting in Jesus' name. Amen.
So thank you, Anthony. The fourth estate and my colleagues, good morning. I know, yes, we should have had this session maybe in an external venue, but I'm sure we all know in government we have austerity measures which are running, and therefore maybe we do with what we have. This morning I want to present the 25th edition of the Capital Markets Soundness report during this media engagement on this 30th day of January 2023. I trust it is not too late for me to say Happy New Year. I think this is our first engagement this year. And I think it gives me just very great pleasure for me to address you as a major component that actually helps us to relay part of the message, part of the information we have as an authority, and we continue appreciating your assistance. This quarter's publication is themed Digitalization in Capital Markets, and it will highlight the emerging trends and opportunities that have come with the application of digital technologies and the impact of social media use in capital markets. I'm happy that we will go through discussions which are very fair. For the stakeholders, we had very good engagements because we learned from our experience in the regulatory sandbox. We also appreciate the fact that the lingering Russia-Ukraine war, aggravated cost of living, and energy crisis on the global front continues to persist as the most pressing global risks. I think if you look at most of the indications we are receiving, perhaps we will still have to cope up with very hard macroeconomic shocks. And this leads us to say investor sentiments seem to have been battered by the extraneous shocks, which have left securities markets unattractive if you look at it globally. With the poor evaluations arising from negative investment sentiments on economic recovery, entities remain averse to coming to market with the securities offerings generally. On the domestic economic front, climate change risks persist, with Kenya registering below average rainfall for the 4 successive seasons. As we have seen, quite a lot of indications on our economic growth as a country, and of course, as the world seems to show things may not improve, as I had mentioned. In the latest World Bank economic update, December 2022, for those who have seen it, they project a 5.2% average growth in GDP, but we have others who have even indicated lower because of the other macroeconomic factors which are hostile and, of course, impacting economic growth negatively. The effective implementation of our new government's initiatives, of course, we hope will address some of these things. But just to say, capital markets regulators, amid these adverse economic developments, continue to position their markets to attract more listings by both private and public issuers. Enhancing investor protection is still important in the 2023 regulatory agenda worldwide. For instance, you will see the experience we have seen in UK Financial Conduct Authority just trying to do certain things, especially on online forex exchange market, just to ensure there is stability. We also note with much appreciation that Egypt has moved to launch Africa's first voluntary carbon market. And as a signatory to the Marrakesh Pledge, the authority has stepped up its efforts in promoting green finance via the capital markets to mitigate the negative effects of climate change. We are engaging the national and county governments and private sector players to leverage on issuing green bonds to raise finance for their green projects. Locally, I think capital markets remained resilient during the quarter under review amidst the challenges which I have just, of course, mentioned. But we hope to see perhaps persistence in some of those external factors. But our prayer is this doesn't continue impacting on capital markets negatively. I want to say thank you so much. I think, as you remember, we have been on a journey to review our legal framework. And as we have said before, we've gone through quite a number of our regulations. I want to report that we have actually made very good progress. We have got the whistleblower regulations approved by the Nation Assembly. Quite a number of other regulations, including public offers regulations, have been published. Of course, credit rating and others. We are in the process of reviewing our licensing regulations, which we believe is very important because it then helps us to handle our goalkeeping role in the market. Once again, I just want to thank you, and I hope we'll have a good engagement as we listen to our technical presentation, maybe in detail, just to cover some of the meat which I have actually just touched on. With that, I want to wish us a good discussion this morning, and hopefully we will continue engaging as we go on. Thank you so much.
What's the next step after the licensing of the coffee brokers? And what's the update on the other regulations that the authority is working on? Thank you.
The capitalization, was there a decrease or an increase in terms of performance in the fund? The quarter ended December. Maybe just break it down for us, kindly.
Okay, thank you. Thank you for the two questions. I think I'll allow Luke and his team to respond on the one on performance at Nairobi Securities Exchange. I think this is part of the presentation, and perhaps I'll just mention something very briefly. Then, of course, Luke will build on this. So, for Eric Ombok, regulations for us in coffee had come in 2020. The only challenge has been we have had very different opinion from the ministry in charge of agriculture, especially as far as coffee is concerned. So if you look at it in 2020, we got the commodities markets regulations, which are general for all commodities. And also we got regulations specific for coffee. However, because of the different views on whose mandate it would have been to regulate different aspects within the supply chain. I think we saw the ministry, of course, introduce changes in some of the regulations, maybe to remove CMA from the regulation of the aspects we had been granted. And let me clarify, it wasn't the whole aspects of coffee from the farmer to the sale of coffee. Our aspect was very simple. The business which takes place within an exchange and the players who are within the exchange. We did appreciate the fact that there were other regulators within the space, of course, the main government, AFA, and then, of course, county governments. But I think the issue which we have had issues around was the business within exchanges, because it was felt perhaps this was going to be done within the Ministry of Agriculture. Now, so far, I think, as you know, there have been quite a bit of discussions around this issue, and it looks like the consensus has been perhaps for the exchange-related business, it still falls within the Capital Market Authority. And that is why you saw we did issue a press notice so that it was very clear, because we saw certain correspondences which indicated to the affected players actually communicating the fact that CMA was the one to license and regulate them. So we have been in discussions. As you know, Nairobi Coffee Exchange is a mutual entity, is still very private, and therefore, for them to admit players, I think there are certain things that we need to meet. We have been in discussions. We continue being in discussions. We have actually asked them to do certain things, and obviously, I can say we have very positive responses. We will continue having meetings so that the licensed persons are actually allowed to access the trading system. I think that is how much I can go on the issue of coffee. But just to say, as it looks, all the players seem to be aligned to the new thinking that, of course, CMA still has a place within regulation of the businesses within the exchanges. And to be very honest, this is the practice within the region. So it's not something which is more peculiar to Kenya. I think it is the practice you see in most of the jurisdictions around us. On the issue of trading at NSE, I think I must admit we have been on a bear run for quite a long time. But I think specifically, we underestimated the effects of Russia-Ukraine war, because we've seen quite a lot of effects out of that. But particularly, I think the responses from foreign investors has been that which actually confirms what we normally say, that capital is good, but it can be very shy because of certain reasons. So with the rising inflation, interest rates, and of course a very strong dollar, we've seen foreign investors take certain trends. It's not only in Kenya, but I think in most of the markets, even in Europe, quite a bit of markets have taken a very heavy beating. So we are hoping that certain measures will be in place that will place us in the path where we reverse the trends we've seen. But I can confirm, yes, trading has not been very much, let me say, in large numbers as we have seen. But also to stress, we've seen very huge transactions, one-off, and of course we expect to see much more. Of course, we will all be aware that maybe in the recent 2 weeks, there has been very heavy trading in Safaricom. although obviously the price was going down, but we are happy that at least it has stabilized at a certain level around 22, 23. So I'll allow my colleague, look, when you present the numbers, be very specific in terms of how the performance has been at NAC.
Members of the Fourth Estate, to the 25th edition of the Capital Markets Soundness Report. We'll be looking at a special feature, which this time is on digitalization, not digitization, of the capital markets. Then we'll move to the global economic, regional, and domestic trends. Similarly, for the capital markets, how have those trends impacted the global and even the domestic capital markets? Then we'll get to the capital market stability indicators proper for the quarter ended December 2022. But just to, first of all, respond to the specific question on market capitalization, we had a decline on the fourth quarter of 2022. We had 2.006 trillion compared to the previous quarter, 2.086 trillion. That's equity market capitalization. So effectively, we had a decline of 80 billion in the last quarter. So it's basically a decline in net worth by 80 billion Kenyan shillings. So moving on, as I said, the key feature is on digitalization, and that's most clearly manifested by His Excellency the President's policy statement around his vision for Mwananchi to be able to access the capital markets from the luxury of their phones as they wait for their next trade. That's the border rider or the... So what does that mean effectively? That we have to really step up on areas that we've already experienced significant growth in digitalization. And when talking about digitalization, this would capture it very aptly in terms of what you've been able to see. A lot of emergence of mobile apps. The NSC has an app. CMA itself has a mobile app. Intention is really to provide information when it comes to the regulator, when it comes to the NSC, even for the CDSC, when you're able to use the USSD perhaps to be able to know whether your shares are moved from your CDS account. But it goes all the way to mobile trading platforms now that have been acquired by stockbrokers, investment banks. Even in the fund management industry, you are now able to see apps that allow you to be able to buy into unit trusts. Moving further, you're looking at the crowdfunding space. So there are a lot of things that are happening in the digital space, and we believe that's the next frontier, particularly for trying to address the concerns around market uptake or uptake of capital markets products. How do we get investors, particularly retail investors, to be able to purchase more frequently, and then ultimately address the concerns around turnover and turnover ratio or liquidity. So here you can be able to see including robo-advisory platforms that we have recently exited from the capital markets regulatory sandbox. But all that combined, we anticipate will significantly address the concerns around turnover and market liquidity, because we'll be having more retail investors participating. Now, a recent study by the International Organization of Securities Commission, that is the body that brings together around 170 securities regulators, like the CMAs across the world. They undertook a study to determine to what extent online marketing techniques are being used. So questionnaires were sent to regulators, and their response, as you can see, when it comes to Africa, a lot of distribution of marketing is through social media ads, and specifically through who we call influencers, like the celebs who come and then they're able to talk about a product. So market intermediaries are using a lot of that across Africa, and generally social media. There's also, when it comes to global, that's Africa only, but when it comes to across the world, then you'll find again that social media banners and display marketing are among the most popular. We also have other modes of communication. Email also seems to be very popular. And this is really by market intermediaries, that's stockbrokers, investment banks, fund managers, who really want to get more retail investors on board. So it's not just the digitalization that I've talked about in Kenya, but it seems to be a worldwide phenomenon in terms of trying to attract retail investors to come into the capital market. But a similar study by the same organization's secretariat, really just to emphasize how investors have been behaving and the emergence of technology following the impact of or the effects of COVID. So this touches on many other aspects of consumer behavior, but if you look at this particular area, social media use at the point of media, out of all these regulators who were interviewed, 69% have acknowledged that social media use has changed significantly. And I think that can be also observed at the point when CMA itself started encouraging use of technology such as the use of EAGMs. And across the world, engagements with our stakeholders was through technology like Zoom and the rest. So this just goes on to explain that there's quite a bit of evolution when it comes to how the market is going forward with while tapping technology. But what has been the real impact of this? Got some very interesting figures. You may acknowledge that 10 years ago, we only had assets under management attributed to unit trusts. Those are the money market funds, the equity funds, the balanced funds. The assets under management was at about 32 billion in 2012, as at September. That has increased as at December to 155 billion, almost 5 times. And at that same point in September 2012, there was an estimated 84,000 retail investors that had subscribed to unit trusts. And we've done a projection from at least 10 fund managers. There are much more, but that has really increased to 257,000. Rough estimate is about 300,000. So you could hypothesize that retail investors may have moved to collective investment schemes instead of going directly, to explain perhaps why there's a bit of a slow trend in terms of direct investment by retails. Of course, that to a very large extent was also driven by IPOs, the last one having been, I think, the last one of NSE. But that aside, what we are trying to determine further, we are still doing further analysis on this, is that perhaps retail investors, based on performance over the years, and probably circumstances where they may have lost funds previously, more than 10 years back, have opted for more professional management option, which they can only be able to get through investment in collective investment schemes. Over and above that, yes, we appreciate that the authority has been a little more flexible with regard to approving category of licensees, particularly fund managers. So that incidence or instance of increase in the number of fund managers to an extent also has led to that, because with new fund managers, they're also coming up with asset classes, some of which really target retail investors. Then the fund managers themselves have got into arrangements with fintechs, or they've set up their fintechs themselves in the form of aggregators that are now helping them to distribute their products. Fine. Some are actually what have been acquired, or there's special arrangements through SLAs or service level agreements with aggregators, but there are also aggregators or other fintechs that have exited the CMA sandbox. For example, we've given two such. We have HISA App and we have CHUMS. These are two exits from the regulatory sandbox. And from then, CHUMS has been able to onboard 50,000 retail investors, transacting up to about 300 million Kenya shillings. Then HISA App, the one that was more or less publicized on the area of fractional shares and ETFs, has also been able to onboard around 20,000 investors, and has the value that they have transacted so far is in the region of 120 million shillings. So, of course, there are stability concerns around that, because the level of financial literacy, as much as we are doing a very concerted one, as the regulator, in consultation or in collaboration with the NSC, with stockbrokers, with the Central Depository and Settlement, the level has not been commensurate with the growth in these platforms. So that could create some kind of consumer bias when it comes to, for example, an influencer. The regulator is not able to get directly to provide rules for an influencer. So would be relying on the intermediary to be able to do the same. Depending on how much the influencer is remunerated, we cannot say to what extent they might be able to provide information without appearing to induce the investor to buy something that perhaps may not be fit for that category. Or maybe it's a product that's better fit for an institutional investor. So these technological platforms also have some disadvantage in terms that they can be able to overload you with information. Information is coming at very high speed. The information may not necessarily be reliable. It might be too much for you. There could be mis-selling in terms of basically telling you you're going to get this time, this kind of returns, 18%, 19%. Sometimes there's also that issue of just unsolicited information. So yes, they're driving the market from the figures and have potential to drive it even much, much more significantly. But we don't rule out the fact that there could be stability risks as a result of decisions that are taken that may not be in the interest. So effectively that could create investor harm or harm if not addressed appropriately. So IOSCO, in that same report that they have done, have come up with a raft of recommendations for regulators to consider. And effectively what the guidance to regulators is that try and have the market intermediaries themselves responsible on the type, quality, and the speed of and the packaging of the information through coming up with proper internal policies and procedures and tools. They should also have specific tools that can be able to filter investors at the point that they're being onboarded, so that you're able to assess the various averseness or investor appetite for each retail investor, and also in the process be able to address the normal KYC requirements. Of course, there's also responsibility for accuracy of the information. So we're saying, my example of an influencer, rather than seek the influencer and say, why are you providing information that is not accurate, management of the market intermediary will have the responsibility on coming up with measures to ensure that those that they onboard to market on their behalf are providing information that are accurate and are not necessarily inducing investors to buy products that are not fit for them. It even goes to an extent of recommending, for those who are familiar with sales, of course, sometimes there are certain qualifications that are required to be a salesperson. They're also saying if you're going to get into online marketing, management of the intermediaries need to come up with some kind of criteria of determining who does that, a trained person, so that they are able to avoid the risks that are associated with the same. There are also instances where you expect these platforms to cross borders. You could have a platform and it's targeting retail investors across various jurisdictions, not just Kenya, with each jurisdiction having their specific rules. So there should also be in place policies around how they can be able to minimize or mitigate the risks of having several internet domains across borders. So while we appreciate that the regulator, that is CMA, already has it in place regulations that sort of assess the extent to which investors could be manipulated or induced, and specifically we refer to the business conduct regulations for market intermediaries. Those are regulations that we have. We have corporate governance regulations for market intermediaries as well. But we're saying over and above that, as we continue to review our regulations, as my CEO had indicated, we are going to see what aspects of recommendations of the IOSCO toolkit could we use to enhance such rules, because digitalization is going to continue and it's going to be exponential. So as we promote, how do we ensure that it doesn't have unintended consequences that are adverse? Now, moving to the global economic performance, we have continued to see revisions of GDP growth downwards. And this time we've seen a forecast or a projection that in 2023, global GDP is going to decline to 2.7%. And just the year ended, it was at 3.2%. It's also, depending on how circumstances move, there's a lot of optimism going forward, but it could go as low as 2% in 2023. And it's important to note that the two fastest growing economies in the world, that's India and Saudi Arabia, are also projected to decline in terms of growth. I think India was at about 6.3%, but it's projected to decline to 6.1%. We had Saudi Arabia at 8.4% GDP in 2022. It's expected to halve to more than 3.7%. So we also note that the Chinese economy is gradually reopening, perhaps that what may determine whether the revision is going to be at 2% or 2.7%. You know, even before the circumstances currently in China, there was the mortgage crisis, and the government has tried to address that concern. There was also the effects of very pronounced regulatory requirements by the Chinese regulator. That's why you had issues like Alibaba, there were concerns there. So that has also lessened. I think the government had taken a stance that various players in the market had to meet very strong prudential requirements, which they have certainly relaxed. So all those, and then, of course, it's also projected that energy prices may have reached a plateau, or may have reached a trough, and could, okay, they've been high, so it's a crest. They might have reached a crest and are now meant to, or projected to decline. So how does that translate? Or let me just talk a little bit more about the economy before we go to how its impact is going to be on the actual capital markets performance. And I think my CEO had talked about Russia, Ukraine, and but there's also this whole issue of monetary policy tightening. So inflation rates are still going up. Interest rates are going up to try and control that. There's still, even as I've qualified that, the fact is that the energy prices are still up. Then I think we reported previously that between 2010, that's at the height of COVID, and end of 2022, global per capita income had declined by 10%. So it's a question of what happened in terms of job security. I think at some point we also reported that during the point of COVID, 2.5 billion people had lost their jobs globally. So all these things that are happening in terms of fiscal and monetary policy interventions, increase in taxes, the disposable income for those who are earning an income is also declining, and ultimately that is reflected in what's happening in the economy, the declining performance. But there are new risks. We've talked about other risks before, like there's a rise in protectionism currently, with the fact that there's a disruption in the global supply chain. What's happening with jurisdictions is that they've decided now, let's keep our products amongst ourselves when it comes to commodities, all that. So the other new risk which we expect to crystallize is the LIBOR transition. As you may be aware, I think we also reported that in previous Soundness reports. A transition was expected from the LIBOR, that's the London Interbank Offer Rate, which, because of governance issues that it had, and particularly during the global financial crisis, there was a loss in confidence in it. And therefore, I believe by June 2023, the LIBOR may be no more and will be replaced by a risk-free benchmark, pricing benchmark. That is the SOFR, the secured overnight financial rate. The difference between them is that, you know, LIBOR was basically determined by a panel. You sit down as various central banks and decide what should be this rate. The new rate, the risk-free rate, and then the LIBOR was not secured. The new ones, the risk-free rates are secured, overnight lending rates projected depending on the tenure of the product that's being offered. So effectively, it may end up being cheaper because it's a secured, it's based on secured assets, the repos So the only risk that we see currently is when you have a LIBOR benchmark, for example, in the pricing of a Eurobond, depending on the various provisions of the agreement that you have in that package, it may reach a point where you had a 20-year, and we are coming to June 2023. So what happens if your Eurobond was priced on a LIBOR benchmark? Right. For us, thankfully, we've got assurance from the central bank that in their projections or their analysis, that is unlikely to affect our current instruments that are issued as Eurobond. So in short, all this that I've talked about has translated into a decline in the MSCI World Index, the MSCI Emerging Index, particularly on a year-on-year basis. But again, when you come to, sorry, this is not too legible. Yeah, but if you look at 10 years, like someone who was holding these instruments last 10 years, there's still a positive real return dollar rate on the same. Now, for the year, the MSCI World Index has declined by 17%. For the emerging markets, it has also declined by 2%. When it comes to Kenya, it has declined by around 30%. So all this that we are talking about is what is translating into this. But interestingly, for the 3 months, for the MSCI World and the MSCI Emerging Index, for the 3 months, that's the 3 months ending December 2022, it has generally posted an increase in returns. For the world index, it's 5.45%, really to suggest that investors or market intermediaries or players in the market are having much more positive projections. As you know, the capital markets normally prices anticipation of what the future is, what they think. And this is what we are talking about. Maybe China, they expect improvements, as I've mentioned. There are also instances, for example, where energy prices are anticipated to decline. So the market is already pricing that, and that is reflected in the positive growth for the 3 months. Now, the Standard Poor 500, that measures a basket of 500 equity securities, the US, and that's the largest index in the US, you can see has declined by 19.4% in 2022. And we note that that is the lowest decline in a year that it has experienced since 2008, when we had the global financial crisis. But you might also argue that when the equity market is going down, the debt market will go up. Not necessarily true from the data that we have currently, because it appears that global debt market activity also declined by 19% in 2022, and even offerings. So there's offerings, IPOs have declined globally, so has fixed income issuances. And how do you able to explain that? It's best explained through the corporate bond, because the corporate bond prices are normally a premium above the treasury bond rate. Now, as inflation is causing governments to increase their interest rates, the corporate bond prices are becoming higher. Therefore, it's becoming very difficult for a potential issuer to issue securities that are going to cost much more. So they are looking at other areas in which they can be able to raise money, and particularly what we are calling the private markets. So you've seen monies moving from the traditional public markets to the private markets. So I'll just explain in brief what's happening to IPOs. A lot of us might think IPOs is a Kenyan problem or an African problem, but it is a global problem. And I think we've explained that even previously. There's a global decline in IPO issuance in favor of private equity space. And even private equity space itself has been on a decline because of these global issues that we've talked about. So IPO globally, in terms of how much is raised, those are the proceeds from issuance, that declined by 61% in 2022. And again, very much as I've explained, there are positive sentiments by the market, which suggests that there could be a turn in fortunes for the better in the coming year. Just a sneak preview of what's happening in Africa. For the last 3 months, or the period ending December 2022, only Botswana, Nigeria, Senegal, Zimbabwe, and Mauritius were able to post positive or an increase in returns as explained by growth in the MSCI index. When it comes to the entire year, then only Senegal has been able to post a positive return. And it's because of just a few selected products, just the way we could be having good performance in NCBA, Stanchart occasionally, which of course have a high market concentration. That's the same thing that has happened in Senegal. A few selected stocks that have a higher market share have led to an overall positive increase in the index. So those are the metrics when it comes to performance, but there are also global activities or reforms that are taking place in various jurisdictions that have stability implications that we may need to consider as a regulator. So we first start with the situation in FCA. This is the Financial Conduct Authority in the UK. So what they have done in the quarter under review was really to write or do a circular to all market intermediaries, asking them to take specific measures, particularly to mitigate the risks of investors that are participating in contracts for difference. This is a form of complex derivative products. It could take the form of online forex trading that we have in our country currently. And when you look at all those combined, derivatives, online forex, other complex products, 80% of investors in the UK have lost money. So there are investments where you put in some kind of leverage in the form of a margin. Then you take advantage of, like if it's currency derivatives, if you're doing a currency pair of the US and the euro, depending on how it moves in the market, you can be in the money or you lose the money. Now, in the UK alone, where we assume there are fairly sophisticated investors, 80% of them have lost from contracts for difference. So, what needs to be done about that? So, in the analysis of Financial Conduct Authority, there have been issues around conflict of interest, where because you have an online or forex trading firm, you may be pushing for higher sales because your point of focus as an online forex broker could be the commissions. Because what happens in trading, especially for an intermediary, whether you are in the money or you are not in the money, the fact that you have done a transaction, there's a commission that's paid for it. So you could be pushing for, you could also be pushing for, many things happen there. There are instances that you can be able to, example, benefit from transfer pricing. For example, you make a loss here and then you offset it against your, if it's your parent company is based abroad. So FCA is actually trying to advise and trying to get market intermediaries, particularly trading these products, to ensure that specific measures are taken such that conflict of interest is reduced. Investors, where they are coming up with agreements where losses are expected, but there's some kind of way in which you can be able to compensate for the loss, to make sure that they focus on better terms. When you lose, to what extent can you lose? You don't lose everything. Right? So such are what we saw happened in the UK, and we believe perhaps that's the reason why we are regulating the online forex market. We've come up with specific requirements in terms of leverage. We've come up with requirements in terms of customer journey, awareness or training of the investor before they get into this product. So that in as much as they have a very high risk appetite, you tell them in advance. You assess them and you say, I don't think you can be able to take up this product. But where the person takes this product, you say, yes, you can lose, but we can have an arrangement where you can only lose to this extent. Right? So we are trying to address that alongside other products with similar risks, risk weights, including derivatives, crypto assets, and the like. And that we have been doing in consultation with the central bank. Okay, I think this is very well-known information, but just to highlight the fact that because of what has been happening with the FTX exchange, which was effectively the exchange, the coin exchange, issuing an ICO, an initial coin offering, in exchange for tokens, and using the proceeds of the same. From their prospectus, they probably said this is going to be used to enhance risk management within the exchange. But ultimately, the CEO had a hedge fund which was playing in the exchange and diverted funds towards the same. So it's a combination of fraud, conflict of interest, and goes to emphasize the need for regulators to oversight cryptos in whatever form. Because oversight does not necessarily, it can take various dimensions. Like the Financial Conduct Authority, for example, decided to stop 21 firms, I think 21 firms, from trading on online. And as a result of doing that, they were able to mitigate against a potential loss of 100 million sterling pounds. So regulation can take the form of preventing a potential loss rather than necessarily mitigating those who have already invested from obtaining a loss or lessening that loss. So you could argue that, yes, if there was an example where CMA decides out of the current online forex traders, half of them for this reason cannot trade. If we use the same case study of Financial Conduct Authority, whereas investors would have lost 80%, because they are not participating, because the brokers are not there, we have mitigated against a potential decline or losses, even before the investment. Then I'm just about to conclude. My CEO talked about Egypt coming up with the first voluntary carbon exchange. This is, we've done very well in terms of ESG. If you look at the ABSA report, which is part of the detailed Soundness report content later, where we have indicated that Kenya has risen 2 places in the AFMI index. A lot of it has been attributed to developments in the area of ESG. So we're talking about us having issued a green bond, green REIT. We have an we have a policy guidance note, that's a regulatory framework for green finance. We have a tax framework. So there's tax exemption when you're issuing a green bond. We have the NSC manual. So a lot of developments, that's what made us really move those 2 places. But there's been an element that has been missing, which really should form the whole package when it talks about green financing, and that is carbon trading. Of course, there was an MOU signed, I think on July 4th, 2022, between Nairobi International Financial Center Authority during the launch of the Nairobi International Financial Center. It was a joint MOU with the Nairobi Securities Exchange, NIFCA, and Air Carbon. And the MOU was really to support the NSC to be able to set up a carbon exchange. The important thing about setting up a carbon exchange is that there are a lot of projects and business in Kenya and even in Africa that are really aimed at reducing carbon transmissions, and in coming up with projects, such projects, you are able to earn carbon credits. So you are issued with a certificate to indicate that because you've been able to reduce the level of carbon by this amount, you have this certificate. There are others, particularly developed countries, but there are also multinationals operating in this country that by nature of their business just have to exceed the minimum thresholds on carbon emissions. And for that reason, they need to purchase these carbon credits from those institutions or those governments that are running projects that are green. So these credits that come in the form of carbon financial products are sold just as the same way you would sell shares and bonds in an exchange. So those who are huge carbon emitters will buy them to meet compliance levels. You will get the money as you sell the certificate, and you can be able to use that towards what we call carbon neutrality. So you can use that to enhance more carbon or more green projects, or you can use the money for other reasons. I don't know, could be debt, some way in which you can also be able to bridge the debt. But the most recommended use of proceeds when you sell off your carbon credits is really to get even further into greening of the economy. So work has already started on the same. CMA's role would be really to see how we can be able to facilitate such an exchange. But in the meantime, Egypt has that exchange where even Kenyan companies can be able to go and trade their carbon credits. It's important to note that this is something that's really in the new government's policy and has already been included in the 4th medium-term plan for the Vision 2030. I'll probably conclude regional issues with what is going on in Ghana. And Ghana, you may be aware, defaulted in some of its debt. about 13 billion US dollars that was due to foreign bondholders. That's effectively Eurobond. Then, of course, they chose which ones they were not going to meet obligations on. One was Eurobonds of certain maturities, then also commercial loans, as opposed to concessionary loans. So that has had significant impact on Ghana. And I think as at end of December, we were talking about inflation of 54%. And of course, a review of the sovereign credit rating, which effectively means that it's not able to get any more debt unless there's intervention, of course, from the IMFs and the World Banks. So what we are reporting is that they've done something that we call bond switch. So effectively, especially institutional investors, if you have a certain maturity of bonds and they are not able to pay, then that's going to be replaced with a longer dated one. So there's some progress around the same. And the impact is, for example, if you're a fund manager or a stockbroker, who are really the targets for investing or for the government paper switch, what happens is that at the point that you report to the regulator or your respective regulator, if it's the pension regulator or the central bank or the capital markets regulator, because you have exchanged a 7-year bond with a 12-year, that has impaired your capital. So as you report, you might find you're not in compliance. So the regulator would naturally take enforcement action. But now what the Securities Commission of Ghana has done is to provide some leniency, something they're calling regulatory capital forbearance. So there's some kind of leniency, like, yes, we'll allow you to not be compliant with regard to your ratios or your prudential requirements for some time. So what this is, the lesson we are learning from this, and God forbid we believe Kenya is able to manage its debt effectively, but should that come to where Ghana is, then we're just seeing the emphasis of regulatory cooperation between the various regulators, because ultimately we will also be having fund managers. We've seen a small bit of it where we also had a debt instrument switch, but it's not at the level of Ghana, which was substantial, and they'd already declared they were not going to pay because they were not able to pay. So we are saying the authority itself would expect its voice to be heard more strongly when it talks about issues around treasury bonds, which effectively is a capital markets instrument, though the central bank is the one issuing it on behalf of the national treasury. But should help be required in terms of supporting a similar approach in terms of managing debt, then the authority will be at hand to support. Moving to our local scene, we've captured very many areas, but we thought this would be of more interest to you as the fourth estate. We've just concluded the report on state of corporate governance. This is the 4th edition. And what is important is that we have continued to experience improvement. Like for firms, a list of 55 firms were assessed on their level of compliance with the principles of corporate governance: transparency, risk management, board balance, just stakeholder activism, all that. There are various principles. And we had a growth of 2% composite score for all the 55, from 70 to 72%, which means there is an improvement in compliance with corporate governance code of 2015 for issuers of securities to the public. We note that in terms of all the principles, you score 75% for leadership, then it goes all the way down. So banks were able to tick the boxes in all the principles of corporate governance, but we had a bit of a concern around compliance with corporate governance principles for companies within the construction and allied sector. But we will be looking at how we can be able to assist them to enhance compliance. I won't go too much into, because we've really been talking about digitization most of this morning, but just to indicate that we continue to exit new firms in the fintech space. The latest one have been robo-advisory firms, and that is really focused on fund management. So we expect ultimately maybe how we exit them. They've done a test with selected investors under certain agreements, under a lower regulatory requirement. Then they exit. Then we provide them with a no objection to roll out the product, but with an intention to follow immediately to come up with the framework that will support that kind of innovation. It could fit into the collective investment schemes or unit trust space, in which case we'll tell them just apply under the collective investment schemes regulations, or we could just tell them to operate until such a time that we'll come up with the regulatory framework, like crowdfunding. So we had Pesesha that came out about 2 years ago. We gave them a no objection, so they've rolled out. But ultimately, we have now published the crowdfunding regulations. So once they become law, then we'll require Pesesha to be able to comply with that law. So that's our approach when it comes to fintechs. We need, at the same time that you are testing, we are also testing or introducing regulatory frameworks to support you to get into the mass market. I conclude on the area of domestic capital markets, just to emphasize, I think this was in the form of a press release, but the joint financial sector regulators, which is the central bank, CMA, IRA, RBA, SASRA. Then we also have KIDC, the Kenya Deposit, KDIC, Kenya Deposit Insurance Corporation. We came together and identified joint concerns around stability of the financial system, bearing in mind the fact that some of banks have intermediaries who have stockbrokers, fund managers. We have some insurance companies that are in the capital markets space across the various financial markets sector. There are other subsectors, and they have intermediaries. So there's that possibility of a systemic risk if something goes wrong with the other. So what financial sector regulators, boards, because those who came together were the boards of each of these regulators, encouraged work on ensuring that there's continuous monitoring of financial system stability. So the way it happens currently is that all the regulators have identified specific market soundness indicators, which they submit to the central bank, and they keep it in one database on a quarterly basis. So a turnover ratio, liquidity, market concentration, capital adequacy, all that, they're kept in a database and monitored. And that is what translates in what you normally see in the form of a financial stability report for the financial sector every year. There are indications that there would be preference to have it 6 monthly, because again, trying to assess how the market was 1 year later might not be in the interest of overall stability monitoring. The other area, it may be of concern that there's some low level of financial literacy in the capital markets, but the truth is that there's low financial literacy across the entire financial sector. So what is being encouraged is joint programs for the financial sector regulators to educate and to sensitize particularly retail investors on the products, their risks, and how we are mitigating. Then, of course, there was emphasis on technology related to digitization. They also noted that there was a lot that was going on previously on Islamic finance. There was an intention to issue a sukuk, a sovereign sukuk, from the various sectors, takaful in the insurance and cooperative sector. That has slowed down. And why this slowed down was that the market was waiting for a national policy on Islamic finance driven by the National Treasury, which sort of delayed. And the two components that Treasury needed to give direction on before we move on Islamic finance, one was whether we were going to look at that product as an Islamic product or just as an alternative asset class. So the question of do we call it Islamic finance? Do we call it participatory finance? Do we call it non-interest finance because it doesn't have a component of interest rates? The second one was on the governance of Sharia products. Do we need a national Sharia board to be able to determine whether a product is Sharia compliant, or do we need just a national advisory board for Sharia? So once we're able, so with that delay, I think the boards have just directed the various regulators to progress work from where they left, even as they wait position from the National Treasury on the same. And very importantly, the joint regulators have also realized and have in their respective sectors been able to assess the impact of climate change. Then lastly, there's been the area of crypto assets, and the regulators have, in the process of setting up a technical committee as guided by the National Treasury of all the financial sector regulators. They will meet stakeholders and ultimately they'll be able to provide direction or advice to the Cabinet Secretary for National Treasury and Economic Planning on what regulatory model, if any, we need to apply in the oversight of crypto assets. So my CEO had talked about the various regulations that are going on. The review is going on two aspects or two perspectives. One, these regulations are more than 10 years old. Actually, some of them are 20 years old, like the CIS regulations, the public offers listing regulations. So the dynamism of the market, the emergence of technology, all these global risks, innovation, we really must change them. We have been changing them, but we'll continue to change them. The second one is that the Statutory Instruments Act requires any regulations that have lapsed since the enactment of that law, and I think it was 2013. Any law before or during, so effectively any law that is more than 10 years old ceases to be law. And that was supposed to be by, I think, June or January 2023. So if you have, for example, licensing regulations and they are more than 10 years old, effectively means that you can't apply the criteria anymore, so you cannot be able to process a license. If you have provisions on enforcement, of course, anybody would ask you which provisions are you using to be able to take up this enforcement or administrative action against us. Thankfully, Parliament has given a 1-year extension. We did a specific application as we highlighted that as a risk, and we sought exemption. We've been given a 1-year exemption. That is not to say we were very determined to have finished a review of those that have expired, and we continue to do so. So we are working with, on doing that. On the two fronts that I've mentioned, you need to make the regulations responsive to changing times. Secondly, you need to be in compliance with the Statutory Instruments Act. So in conclusion, this is the level of health or soundness of the capital markets for the period ending December 2022. We still have a fairly low volatility market. And low volatility is really a function of low activity. So because foreign investors have mainly exited and they're the drivers to the market, you're not having those speculations too much around how much am I selling today, how much am I buying next month. So that has reduced the volatility. To a large extent, there's also that element of the stability after the elections, whereby there's no longer panic to be able to take short-term positions immediately. Then on market concentration, that remains a high risk, and we are happy with the pronouncement by the President on possibility of having some privatizations through the Nairobi Securities Exchange. And we are also happy that there's already been a draft for exposure of the revised Privatization Act. So there's indications that we are probably going to get some more big ticket companies that would address the concerns around market concentration by the top 5 and specifically Safaricom. Then we have the Settlement Guarantee Fund. Oh, there's market liquidity. Market liquidity still remains low, and that is despite the various initiatives that we've talked about, which are positive. That is retail investors getting into the market. We introduced the securities lending and borrowing by the CDSC. The board of CMA has recently approved margin trading policy. So those are just measures. There's been some requirements for introduction of market makers. So all that combination of, then there's day trading. Day trading was also thought to be one of the solutions to the same. But unfortunately, day trading has had a hitch with regard to the costs. Because if you're doing an average trade of 2.1% transaction cost, then if you're going to roll over your portfolio 4 times in a day, effectively you're paying 8%. So one of the issues that we are looking at in our next strategic plan, which begins in July 2023, is how we can be able to look at the whole issue of transaction costs within the capital markets. And that should touch on even day trading. Of course, NSE gave a rebate, but there's still the regulatory cost, which we cannot waive ourselves because it's a statutory cost. It's like a tax. So we just want to look at that whole issue of costs holistically. Then probably that is when we are going to reap the fruits from day trading as anticipated. Foreign investors has been on a decline in terms of market share, in terms of trading. During the quarter, it increased because you recall the other time we registered 45%, That has increased by 54%, but we are not saying that that's really a positive move, because very few transactions were done by foreign investors. So if we're able to look at the subsequent quarters, then you can argue that foreign investors are back and are trading, and therefore you expect the market to perhaps reverse its bearish trend. So that is on foreign flows. The outflow has been reducing, but it's still very high. We have, the last quarter was 4.87 billion, compared to the previous quarter, 6.9, but these are still outflows. So again, you might want to argue that who are they selling to? So they are still investors. Our analysis suggests that most of them are institutional investors. So someone would argue that, of course, for a stable market, you need to have much more participation by your local investors. So it's a plus on one end, it's a minus on the other, especially in terms of the fact that they're the ones who actually control the market share when it comes to trading. Then lastly, just settlement guarantee fund, just on basis of risk assessments that we've done. We have actually observed that in the unlikely event of a default by any of the trading participants in the stock market, that loss is already covered up to 4 times, 4.26 times of the potential loss if there was such a default, by the monies that are already in the settlement guarantee fund. So I'll stop there, and thank you very much for your audience.
The first one is, what's the outlook for the NSE performance, at least for the first quarter of this year? Then secondly, with regards to the unit trusts, what's the assets under management at the end of Q3 or at the end of December 2021? And still on the same, what was the number of retail investors in unit trusts at the end of Q3 or at the end of 2021? Thank you.
Presentation, you had mentioned that digitalization is key in this industry. And you went ahead to say that digitalization of investment advisors will serve to make investment advisory a sustainable business model for the long-term development of capital market. When are we likely to see this? Is it maybe in the first quarter of this year or second or third? Thank you. Just a clarification.
Okay, outlook is normally a difficult question. Perhaps when you're talking about outlook for the capital markets as a whole, because when you're talking about trading itself in the stock market, the circumstances or the developments that we have highlighted still suggest that net foreign outflow may continue to persist. And while we appreciate that our secondary market, particularly equities, is driven largely by foreign investors, if the activity is declining, it is unlikely that you're going to see an immediate change in fortunes from a bearish market to a bull market. So at best, we expect it to remain the same. Of course, there are developments with regard to other parameters like turnover, and my CEO mentioned where there are substantial trade in counters such as Safaricom, depending on the outlook of both domestic and foreign investors about the fact that our market prices may be largely undervalued, assuming they want to hold for the long term. And as I indicated, foreign investors seem to be selling mainly to institutional investors like pension schemes. So they're likely to hold for longer. So with less activity, you still expect that sort of performance that we are seeing now to remain on a plateau. But when it comes to other asset classes, and particularly when you bring in the capital markets proper, and you're looking at how much the government is expecting to raise before the next budget cycle, then you expect still primary issues to come in the form of treasury bonds. If you're looking at government policy on housing, we would not rule out the possibility of having a national REIT issue, because the president has pronounced itself on that. What we could perhaps not be able to experience immediately is perhaps IPOs, which are the largest drivers when it comes to the secondary market because of the excitement that they bring on board. So it seems more likely that in terms of performance, if we are to see anything positive, it should be more on the other asset classes, particularly the fixed income market. We would also probably expect a few corporate bond issues because, as you know, it had revitalized previously. So in terms of secondary market trade, it appears until fortunes turn, and we indicated it in the presentation, that sentiments become more optimistic and we have a return of foreign investors, then it is our view that the market may continue to remain depressed. When it comes to sustainable business, this is thank you for that question. This will really depend on how active the licensee, because we've already issued licenses. We've issued licenses to the fund managers. We've issued no objections to specific fintechs to be able to roll out the product. So it is upon them and the methodology they're going to use, the channels they're going to use to communicate, and whether they're going to target institutional investors or they're going to target retail investors, that will determine how fast. But going by projections that we've been able to see, for example, of HISA, we give the example of CHUMS. This is effectively a fintech solution that asks you anytime you are buying something else, perhaps in a supermarket, says, I can see, because it's using artificial intelligence, I can see you want to buy this product. Can you just save 5 shillings from that? Then from there, it can be put into various asset classes. So I wouldn't really say from a regulator's perspective we can be able to project, but we can say we have been able to facilitate even fund managers to come up with SLA agreements with the fintech providers for aggregation. So depending on how they really push, and going by projections, we are seeing an increase. My team will probably confirm, but we've been seeing an increase every quarter of roughly 5 billion in terms of asset under management. At some point, we had 147. At the beginning of the year, we had 152, 151. So it's roughly about 5 billion shillings. That's the AUM increasing by. I hope my team will be able to get the 2021 figures shortly. All right. Just give me the same. Yeah. So the biggest rise in AUM has been, I should say, in the last 2 to 3 years, because there was a plateau at some point where we stuck at 32. Okay, this one we had already talked about. It was 155 as at September 2022. It was 32 billion in 2012 September. You've asked for 221. I can only give a rough estimate. It could have been around 139, 140, given by the trend at which they have been rising. But what is pronounced is that from around, let's say, the last 3 years, we have seen a spiral. And that has coincided with the approval of the new platforms or approval of fund managers to use platforms that they have acquired from aggregators. Right? Yeah, but ultimately I promise us to share the exact figures. I think it should be in the capital markets statistical bulletin, because that covers it from 2009, I think. All right. So even in terms of the retail, I'll be very clear on that. We have done projections based on 5 of the top firms, 5 of the top fund managers. We have projected to the other fund managers, and that's where I was coming up with the figure of 257,000 retail investors, could go all the way to 300,000. But we are still doing further analysis to be able to say year by year what has been the increase. Has it been retail foreign? Has it been retained local? Has it been mainly institutional investors? It's work in progress, but I think we were challenged last time to determine whether CIS have been responsible for the shift of investment from the stock exchange directly to, so that's the interim figure that we were able to get. Okay.
Regulations last year. Just wanted to know, so far, have you had any whistleblowers coming forth to point out malpractices in some firms? And if so, how many are they, and did you reward them? You can touch on that. And then just expound more on this, the impact that reviewing these capital market regulations are going to have. You've talked about 1 year extension, I think you got from Parliament. Yes, just expound more on that. Thank you.
A process. First, it is we go through stakeholder engagement, then we pass it through our board. Then the board submits it to the National Treasury. The National Treasury takes it to the AG. Then the AG translates whatever we have into the language that's understood in the AG's office. That is when it is published. Once it is published under the Statutory Instruments Act, there's a period of time in which the Committee on Delegated Legislation, that's a subcommittee of Parliament, is supposed to engage us. Then we try and explain particularly whether we met stakeholders, whether we incorporated. So what happened is that it was initially published, then it is in December that we met the Committee on Delegated Legislation, and almost immediately after that, that's when it became law. So before it's operationalized, there's nothing we could have done. We are just anticipating that our awareness team and our communications team will be sending out information to the public that we now have in place a whistleblower policy whereby you can be given up to 3%, 5% of the proceeds if recovered, or 5 million. There's a threshold there of 5 million. So it's 3% of the value that's recovered by the authority, but subject to a maximum of 5 million. So your direct question on has anybody benefited from that? Not yet. There have been some information submitted through our complaints portal, but not with the intention to be compensated, because I think whoever was posting or whoever have been posting certain complaints are already aware that they will not be subject to that compensation. So we can only anticipate that it's going to be an incentive now for those who have very important information that could be able to assist us to make recoveries or to take enforcement action. Then that is when we anticipate that they're going to come in. On the set of regulations, they sort out, as I indicated, and thanks for reminding us, it was not just the Statutory Instruments Act. It's really the regulations fit for purpose. Like now, technology. have we included provisions with regard to innovations on the various review. We look at the example of collective investment schemes. We only had one aspect of collective investment schemes, so only unit trusts were considered as collective investment schemes, for example. But now we have expanded the scope to include all sorts of mutual funds. That is both open-end mutual funds and closed-end. So we are going to have instances once we have these regulations operationals whereby we might even have collective investment schemes that are trading on the Nairobi Securities Exchange itself. Currently, they don't. Right? Then when you look at the collective investment, we've also tried to address just general gaps with regard to pricing to ensure that if you're looking at Britam money market fund and you want to compare it with NCBA, then they're using the same methodology, and therefore you can be able to determine that this is a better proposition for me as an investor because they're actually providing an 11% return compared to the other. So those are some of the issues that have been addressed, and there have been concerns that were raised, for example, by investors who said they are not able to determine which is a better buy between two unit trusts because they were using a completely different methodology to price. Right? Then there's been that aspect of an introduction of an alternative investment fund regulations. So if you are not being licensed as a unit trust or any other collective investment scheme, formal collective investment scheme that falls within the jurisdiction of CMA, if you, example, have a private fund, if you have a hedge fund, and that is going to solve the issue whereby some issuers indicated that their products do not fall within the jurisdiction of CMA. So we have we have another set of regulations that we've come up with, which will still allow you, irrespective of whether you want to call yourself a private offer or what, there are still certain conditions that you'll need to meet. Previously, what you really needed to tell us is that you're not a private offer, therefore you are a private offer, so you don't fall within our jurisdiction. When you look at crowdfunding regulations, they're now addressing SMEs who might not want to go to the mainstream exchange. So you can have a startup wants to raise money from a number of people using the internet. The crowdfunding regulations are able to address that. So we are expanding to be able to capture capital needs and capital supply by all sorts of investors and all sorts of companies, irrespective of whether they are startups, they are mature companies, they are SMEs, they are micro. So the other thing that we are looking at when it comes to public offers listing and disclosure regulations is that we have now been able to come up with specific SME segment for each product. So if you're doing equity, there's SME equity, SME debt, right? Then, so there's a main market, there's an SME market. So it is in consideration of the fact that the requirements of small and medium enterprises might not be the same as the Safaricom's and the EBL. So if you're asking like corporate governance requirements that Safaricom should meet, it should not be the same as one where maybe Superloaf should be able to meet. It also removes certain other requirements. You know, we required 1,000 shareholders for you to come to the market to do an IPO. We've been able to reduce that substantially. I think it's now 300 or 500. Prudential requirements, paid up capital, we've also decided to reduce that. So we've even free float. There were instances where you are required, like if you want to raise money from the stock market, then you have to offer at least this percentage to the public. We've tried to reduce that also substantially. So it's basically just reacting to what those who would want to come to the market but have not, and we've engaged, have told us, if you change this and this, we are ready to come to the market. No, we have had annual, almost every year, we have had amendments to our regulations, particularly the public offers, to an extent that sometimes it has been said it has been amended so much that you can't recognize it from 2001. That's when, 2001. So those were amendments just to react to certain gaps that we had seen, certain complaints. But now we are looking at it holistically. What are the global conditions? What is the, what's the investment or investor behavior currently compared to 20 years ago? What's the issuer behavior compared to 20 years ago? How do we bring in technology? Because technology, again, it's very difficult to associate with ownership. How do we address governance around the same? So it's just those emerging trends and the overall dynamism of the capital markets that has led us to look at it afresh, in spite of the fact that we've been making piecemeal changes to it over the years. Okay, I've just got the figures. Perhaps you won't have the retail investors, which we promise to have perhaps in the next quarter. So 2021, we had 134 billion assets under management by CIS. 2018 was 61 billion. 2019 was 76 billion. So this rise actually starts from 2020, where we have 104 billion. The following year, 134. Then last year, 122. So that's where we've actually seen the highest growth the last 4 years. Longer term solution is to, corporate governance compliance is effectively based on a code. So what we are trying to do in the long term is because when you look at things like a code, guideline, as opposed to regulation, they tend to have a lower regulatory weight. Someone can get away with saying these are not regulations. So we are going to try as much as possible in the long term as to whether we can be able to actually convert them into corporate governance regulations. There are those objection letter we give them certain conditions with it. So we say, please continue and get into the market fully, but under these conditions. But we are following up with crowdfunding regulations, and once it is there, you will need to comply with it, and that applies across. There are also instances whereby once a fintech has been exited, it may find itself now eligible to be licensed under our existing regulations. You might find there are regulations with regard to collective investment schemes. If you are doing robo-advisory services, it's effectively automated fund management, so you'll fall within that space. So we have a way in which you can be able to, if we don't have the regulations, we give you a small window to be able to operate, follow up with the regulations, or we amend the regulations to suit this business, or we actually write a new set.
The questions that are being asked, especially on the performance, we also have a quarterly statistical bulletin that we always release to the press. It's on our website, but we'll be able also to circulate it together with the Soundness report, just for the benefit of the ones. More details on the questions, if you want to look at the performance and all that, that information is concentrated there. Thank you.
Two publications that come out at the same time. Sometimes you tend to quote the other one with the other statistics. So the Quality Statistical Bulletin provides aggregate data. That has been released, That talks about market capitalization, turnover, index, all that. But this session is about soundness indicators. So we use those aggregate indicators to now determine how healthy the market is. That is why instead of talking about market capitalization, we are talking about turnover ratio, which is turnover divided by market capitalization. So it gives you another parameter which indicates that the market is liquid. Because you could have a very high turnover, but just from one transaction. So the market is not liquid. So the soundness report provides an assessment of the soundness and health of the capital markets, while the soundness report, which we are presenting today, that's the one that talks about the sound and health. The other one, which is released at the same time, gives aggregate market statistics. So it's just an explanation. I don't even know whether it's performance. Yeah, it's performance, but not necessarily stability.
CEO, who has just stepped out, directors present, Helen and Mr. Luke, members of CMA management present, CMA staff, media houses present, all protocols observed. Good morning, everyone. My name is Viola Kilel, Senior Product Development Officer within the Directorate of Policy and Market Development. First, I'd like to start by thanking our CMA Chief Executive Officer, Mr. FCPA Wycliffe Shamia, for making time out of his busy schedule to attend this CMSR media briefing session and also to offer his introductory remarks and answer emerging questions from the media houses. I'd also like to sincerely thank Mr. Luke Ombara for delivering a highly insightful and robust presentation covering the special feature on digitization of capital markets, developments within the capital markets globally, regionally, and in the domestic market, and also on the capital market soundness indicators. I'd also like to thank the media houses and recognize the presence of KBC Radio, KBC TV, Y254 TV, Citizen TV, KTN News, NMG Business Daily, NTV Business, and Bloomberg, as well as Mr. Charlie Media. I believe that the articles and news that will result from this session today will go a long way in demystifying capital markets issues, as well as keeping the public and the investors up to date on all the capital markets initiatives and performance indicators. I'd also like to thank the policy team, the Policy and Regulatory Framework team, led by Mr. Jairus Mwaka, and Director Luke Ombara for coming up with this CMSR publication, which is a very good publication on a quarterly basis. And lastly, I'd like to thank Mr. Mwangi for facilitating this session, and also just to thank all of you who are present today for attending this session. Thank you very much, and I'd like to now pray for the tea.